Social Security is the most complex benefit system most Americans interact with, and the rules are buried in 700 pages of Program Operations Manual. In the next 7 minutes, I'm going to walk you through 5 specific mechanics that catch retirees off guard. We start with the widow remarriage rule, then bend points and the progressive formula, the Medicare IRMA cliff, the spousal 50% benefit, and finally, the claim at 62 mistake. Each rule in 60 seconds with the statute, the number, and the action. Let us start. Social Security widow and widower benefits give you up to 100% of your deceased spouse's check, but remarriage before age 60 wipes the benefit out completely. The rule: remarry before 60, you forfeit widow benefits on the deceased spouse. Remarry at or after 60, no impact. Remarry after 50 if disabled, no impact. Why 60 matters. Congress in 1983 set this age as the cutoff. The rationale was that someone widowed at 60 plus would have built financial dependency on the deceased spouse's benefit, and remarriage would not eliminate that need. The exception that brings it back. If your new marriage ends in death, divorce, or annulment, eligibility on the original deceased spouse returns. The clock restarts. Strategic note: many widows planning to remarry wait until age 60 to preserve survivor benefits. This rule does not apply to divorced spouse benefits, which have separate remarriage rules. Mechanics, not legal or financial advice. Social Security does not pay you a flat percentage of your earnings. It uses a progressive formula called bend points. Low earnings get replaced at 90%. High earnings get replaced at only 15%. The mechanic: the Social Security Administration calculates your average indexed monthly earnings, or AIME, using your top 35 years of earnings. Then it applies 3 brackets. The brackets in 2026, the first $1,226 of IAME is replaced at 90%. Earnings from $1,226 up to $7,391 are replaced at 32%. Earnings above $7,391 are replaced at only 15%. 3 takeaways. 1. An extra year of low earnings adds more lifetime benefit than an extra year of high earnings because of the 90% bracket. 2. High earners replace a much smaller share of their working income at retirement, which is why most need additional savings. 3. Any year with 0 earnings drags down your average and your benefit. Why this matters. Most people picture Social Security as a flat percentage. It is not. It is heavily progressive, and the math changes how you should plan. Mechanics only, not financial advice. If your income crosses a Medicare premium threshold by $1, your premiums can jump by hundreds per month for the entire year. This is the IRMAA surcharge. IRMAA stands for Income-Related Monthly Adjustment Amount. It applies to Medicare Part B and Part D premiums. The mechanic: Medicare uses your tax return from 2 years ago. The 2026 brackets use your 2024 income. Cross a threshold by even $1, and you jump to the next tier for all 12 months. The tiers in 2026 for individuals: below $106,000, standard premium; $106,000 to $133,000, surcharge $74 per month; above $500,000, surcharge $584 per month. For married filing jointly. Doubles the income thresholds. The trap: a Roth conversion, a capital gain, or a large bonus can push you over a bracket. $1 over could mean over $1,000 more in Medicare premiums that year. The fix: file form SSA 44 for life-changing events like retirement or divorce. You can also do Roth conversions in lower income years before age 63. Mechanics, not financial advice. If you are married, you can claim up to 50% of your spouse's Social Security check, even if you never worked. This is the spousal benefit. The rule: you get the higher of your own earned benefit, or up to 50% of your spouse's benefit at their full retirement age. You can only claim spousal once your spouse has filed for their own benefit. Both of you must be at least 62. The 50% cap is set at the spouse's FRA. If you claim spousal before your own FRA, the spousal portion is reduced too. Divorced and married 10 plus years? Same rule applies, and you do not need your ex to file. You can claim on their record at 62 plus. Survivor benefits are separate and can be 100% of the deceased spouse's check. Mechanics, not financial advice. Social Security gives you a different monthly check depending on when you claim. The reference age is your full retirement age, FRA. For everyone born in 1960 or later, FRA is 67. Claim at 62, the earliest age. You lock in a permanent 30% cut to every check for life. Claim at FRA 67. You get 100% of your earned benefit. Claim at 70, the latest the bonus accrues. You get 124%. That is 8% per year of delayed retirement credits between 67 and 70. So a benefit of $2,000 at 67 becomes $1,400 at 62, or $2,480 at 70. Same earnings record, 3 different checks. The break even between claiming at 62 and 67 is usually age 78 to 80. Mechanics, not financial advice. Health and spouse situation change the math. That is 5 Social Security mechanics, 3 takeaways. 1. The system is heavily progressive, but high earners replace a much smaller share of pre-retirement income, which is why most need additional savings. 2. Most claim timing mistakes are irreversible after 12 months. Run the math before you file. 3. The SSA will not warn you about IRMAA, the widow remarriage trap, or the spousal benefit cap. You have to know to ask. Subscribe for more Social Security mechanics. We publish a 60-second short every day. The description has the link to every individual short. Mechanics only. Confirm your specific situation with SSA before acting.